Well, hi, gold traders. Chris Weston here, head of research at Pepperstone. So we're back once again having a deep dive into the gold market. We're going to look at all the facets that go into our risk-reward trade-off, positioning, sentiment, and what's going on in bond markets effectively. And then, of course, take a look at the technicals to give us a sense of whether this bullish underlying move that we've been seeing over the last 5 days can continue in earnest. And it's been strong. I mean, we've seen the gold market over the last 5 days in US dollar terms up 1.3%. But what I really like about this is that gold's been rallying in all currency terms. So it's not just been a currency effect. Gold is actually moving higher. We're seeing the rate of change moving to the upside. And of course, we don't offer gold just in US dollar terms. We offer it in multiple different currencies, in the Swiss franc, Japanese yen, euro, Aussie dollar, and the pound as well. And the idea here is that if you go to the MT5 platform, MT4 platform, you can see those currencies, XAU, JPY, for example. And we really want to be long gold in the perceived weakest currency, and we want to be short of gold in the strongest currency. And that's where we can max out the P&L effect. If you have a look at this chart here, you can see that over the last 5 days, of those currencies that we offer gold in, the Japanese yen and the euro have been the weakest. So being long of gold in Japanese yen and euros would have obviously been a better trade from a percentage perspective than being long of gold in US dollar terms. And being short of gold in Aussie dollar terms, XAU, AUD, would have mitigated some of the downside you've seen from that stronger trend. So that's really where we're looking. Of course, this doesn't project on the performance going forward, but we really need to understand that you can obviously trade gold in US dollar terms, and that's what we'll look at today. But also, if you want to max out the effects, buying gold in the weakest currency is obviously going to help in that situation as well. Now, let's have a look at the positioning that we've seen in the market. The first one we're going to bring up is client sentiment. Now, if you look at the positioning which we can see in silver, look at the net longs or the skew of long to short positions, you can see that actually in silver that clients are really, really bullish on silver, but it's much more nuanced in gold. Of course, we've had a big move in gold, and I think people are looking to counter trend that move. I think that, there's different time frames that play into this. Some people are holding positions for 5 seconds, some people are holding them for 2 days, and there's a kind of a hodgepodge that comes into this sort of this skew. But you can see that people are quite mixed on what's been happening here. If you have a look at the futures market, though, we have seen a pickup in the net long that the market's holding at the moment. This is managed money. This is the weekly CFTC data. And you can see that's at 93,000 there. So that has picked up a little bit from last week, but it's not at any kind of levels that I would be concerned about. If we go back to 2019, Q1, Q2 of 2020, we can see 300,000 or near 300,000 net long contracts. If we'd seen a move up in real yields or nominal treasuries or the dollar had strengthened, that's when you get that exaggerated move to the downside, because the market is so long of gold that any kind of negative factors playing to the gold market really perpetuates that move lower. At the moment, we've seen a little bit of a pickup in gold open interest and also futures interest, but it's not at levels where I'd be really genuinely concerned. If you have a look at the GLD ETF, the gold ETF, you can see that there has been a series throughout this year and last year of outflows from the GLD, and that's probably abated a little bit now. But we haven't seen any major pickup in interest in inflows into the GLD, and that's something that we will be watching very closely. So from a flow perspective, it's not really been over-exaggerated. Now, what I like is this chart here. I use this as a basic model. Now, the correlation between the two has broken down a little bit, but if you look at the top pane, you can see the white line is the 10-year inflation-adjusted real yield of the US Treasury. So when we look at inflation expectations and we subtract that from the nominal US 10-year Treasury, we get a situation where that's now at negative 101 or 101 basis points. The gold market, which I've inverted or flipped upside down, has for periods shown very, very strong correlations here. And the reason being, or the fundamental rationale being here, is that the real returns that you're getting in the bond market, if they're becoming more negative, then that makes gold more attractive from a relative perspective, and vice versa. When real yields become less negative, you see a situation where the gold becomes relatively less compelling to own as a portfolio hedge, for example. Now, that correlation has broken down a little bit. The question is when we asked this last week, can we see some mean reversion playing through? With real yields continuing to fall despite what we're seeing in inflation and US economics and PPI and the Fed meeting next week, for example, real yields continue to push lower, and that's supporting the gold market. We saw that last week, and that continues to be the case. We're through that round number, negative 100 basis points, and if that continues in this trajectory that we've been seeing, and that heads down into those lows that we saw in 2020, 2021 of negative negative 111 basis points, then this gold market is going to continue to move up to where I believe will probably be the testament of 1853. So something we are looking at very closely. If we look at this from a basic model perspective, that correlation has broken down. But if we continue to see the real returns in the bond market go deeper negative, then the gold price is going to go one way, and that is higher. If we see that obviously reversing, and we see a situation where real yields move higher, then of course we're going to see a situation where the US dollar strengthens and gold prices are going to come under pressure. Okay, let's break it down into the nuts and bolts of what we're seeing in the gold market from a technical perspective. As you can see here, this is gold in US dollar terms, where of course we see the bulk of the flow. We talked about this last week, where we talked about the market going into this 38.2% retracement at 1815. We sort of hobbled along over the last sort of 4 or 5 days, just consolidating into that level there. And market wasn't really prepared to do too much. We didn't want to roll over. As you can see here, the buyers stepped in on the 12th and held the 5-day exponential moving average. I really like that you've got this exponential moving average moving higher, and the buyers are stepping in and supporting on a daily chart into that average. They do not want to see price close below that level. I really like what I saw around there, and that was just convincing me. We just needed to see some buying coming through. Now, if you see what we saw yesterday, we saw a situation where we saw a higher high, price opened up, traded down to 1802. We're pretty much down to the round number. And then we've seen this massive wave of buyers stepping in. A lot of that down to the fact that we've seen lower real yields playing through in the US Treasury market. It's made gold more attractive. The US dollar's weakened off, but you can see that the buyers have really established control. Now, it's taken through and closed through the 200-day moving average, but it's not convincing at this stage. At this point, we've got a bit of indecision, but it's early days. Now, the trend is true, and I want to trade with a trend. So certainly I've got a long bias at the moment. Upside should be capped into 1853. On the week, over the next 5 days, if we see a move into 1853, I'll probably be looking to square and reverse. I'll be looking to fade there, and I'll probably hold about a 70% level of confidence around that. And the reason being is that is the straddle pricing. So in the options market, they're anticipating with a 68.2% level of confidence that price should get and be capped around 1853. So I think we have the ability to get up to this sort of 61.8% retracement of that move, but I think that's where I'd be looking to square and reverse positions down there. On the downside, if we were to see positions roll over, I think that this low and also coincide with the straddle level down at 1803 probably represents a good level to be looking to fade that sell-off. But the preference at the moment is to buy pullbacks for a move up into 1853. That's where the flow is at the moment. The market's respecting this 5-day exponential moving average. Until we can close below that level, then I think the path of least resistance at the moment is higher, and we've seen that with the positioning. The position is not overly stretched. We do have the Fed meeting next week, and that's something that we do need to consider ourselves. As we saw from the currency chart, gold in yen terms has been really strong. Again, that looks really good at the moment. So I'm staying long in that situation. And one of the currencies which has done really well is gold in euro dollar terms. And I'm not going to go through what the ECB have said, but of course in this situation we are looking for these June highs to come into play around 1565. Look at the strength we've been seeing from these lows in gold in euro dollar terms at the moment. So that's really one to keep an eye on. Let's have a look at gold in Aussie dollar terms. And again, very, very strong price action playing through. Broke through the 200-day moving average with ease. We're making a higher highs. And you can see here, we're just looking to go through. So I think gold in Aussie dollar terms looks pretty good at the moment. I want to stay long in that currency here for a move back into 2,470, back into these kind of highs here as well. So gold really in all currencies is looking pretty good. We do have the Fed meeting next week. Can we see a change of direction in real yields? Can that move the US dollar? But at the moment, regardless of the time frame that I'm looking at, but certainly on the longer term time frames, gold looks pretty attractive at the moment. And as long as real yields push down to negative 111 basis points, then gold's only going one direction, in my opinion. So stay safe and trade it with Pepperstone.